Well, thank you all very much indeed. In fact, you will see that the title is slightly different. This was the title I proposed to the organizers, but it seems to have changed a bit in the program. But I do think it's very interesting to understand how policy affects the market, because policies, many things are going on, which I'm going to touch on, which are influencing, maybe not directly, might be soybean, but it affects the palm market. So what I'm going to do today is, I need to see what's down there. So I think it's clear governments affect markets. And I think I have no choice but to start with what's going on with Mr. Trump. Because as I will show you, he is having a big impact on the soy oil price in all kinds of funny ways, and then it's going to have an impact upon you. So I'm going to look at his trade wars. In particular, the one that matters is with China. And then I'm going to look at how the EPA, his Environment Protection Agency, which actually doesn't seem to want to protect the environment at all, what it's doing to water down renewable fuel targets, and I'm going to show you what this has done to the soy oil price, and therefore indirectly also palm oil. I have to say something about EU, because we know about the EU Parliament's hostility to palm and the new biofuel proposals. Well, now they are passed by the European Commission, European Council, to phase out palm oil from biodiesel. So I'm going to touch on that briefly. And then I'm going to come to a very important, more local concern, which is Malaysia and Indonesia biodiesel policy, particularly Indonesia, because I see them as having a very major role right now in helping in some ways to stabilize the market. And so I'm going to end by looking at palm oil production, and I'm going to look the famous price band and look at palm oil prices. So I've got quite a lot to do. So let's start off with the US and China and the trade war. And I'm never quite sure in these halls if people at the back can see the bottom of the screen. So I quickly this morning pulled up all my diagrams towards the top to be sure that you can see it. On the left-hand side, what I show you is just what the war with China has done to soybean prices, really, in US. They're both about US soybean prices. The one on the left is showing you how suddenly Argentine FOB soybean prices, which are in blue, have gone above the US Gulf FOB price. And the green line just shows you that differential. The trade war has had the effect of creating a $100 premium, if you like, for Argentine soybean over US soybean. That's one effect of the tariff. The other group that it's hit more directly is US farmers, which ironically tended to be the people who voted for Mr. Trump. And what I'm showing you in the right-hand diagram is how the soybean price US Gulf is in red, and I'm taking South Dakota because you can get those prices easily inside US, how they have gone to bigger and bigger discounts to the Argentine price. One effect of what has happened with the trade war is you can see if you're stuck in the upper Midwest, which traditionally exported to China through the Pacific, you have seen your discount go down from something like 12%, if you look back at the start of the year. The discount's now more than 35%. I was at a meeting of Iowa soybean farmers about 3 weeks ago, and I met someone who had a large but not especially large farm. I suspect he still votes for Mr. Trump, but he said he has lost $150,000 of revenue simply because of what you can see here that's been happening to prices. I mean, it has, okay, that's soybean, but I want to go on and have a look a bit at biodiesel policy, which is the US, and soybean oil. So already the trade war has hit the soybean price. If we look at biodiesel policy, I don't know how many of you are familiar with the US system, but they have tradable certificates for the mandates. They're called RINs, Renewable Identification Number. And in this diagram, they tend to talk about RINs in cents per gallon. And I've converted it to biodiesel equivalent. And I actually, in the left-hand slide, I show you ethanol as well as biodiesel, because ethanol is the big biofuel. And what has happened with the EPA giving waivers, suddenly allowing many refiners not to have to blend biofuels. They've turned against biofuels. And the RIN value, you can see the blue line measured on the left, that's for ethanol, has plunged in value. Also, in red, that is the RIN value in cents per gallon for biodiesel. But what's interesting is the RIN value in dollars per ton of soybean oil, which is what I do on the right-hand side. And you can probably see it goes, wait, I pressed the wrong one. You can see that it goes, if you can see, well, it's not very bright, but you can see the value per ton of soybean oil, of a RIN, in the last year has gone from nearly $500 per ton to less than $200. What the EPA has done with its policy is to reduce the value of biodiesel mandates to US producers by more than $300 a ton. As a result, if on the right-hand side you look at the prices in dollars per ton, these are daily prices. I've smoothed it a bit by making it a moving average. The blue is CBOT soybean oil prices. The red line is WTI, the usual US crude oil. And you can see, actually, the soy oil price is lower than it's been all the way back to 2015. It's lower than it was in 2017 and 2016. The effect of what they have done to biofuels has been actually to reduce the soy oil price. And yet at the same time, crude oil, which I think you know, and I'll come to it, is at the bottom of the price band that links petroleum to vegetable oils. Look how crude oil has gone up. Crude oil has gone up by, over this period, $300, and yet the soy oil price has fallen. And the reason is, not entirely, but in part because the support from biofuels has been removed by the US government. If we look at EU policy, and I'm showing you a diagram which has nothing to do with the EU, but I'm looking at the underlying growth in planted areas. Left is Malaysia, right is Indonesia. A percentage growth in the palm oil area, Malaysia and Indonesia. And I've fitted to this, these are percentage growth rates. I've fitted a dotted line to show the trend over time in the growth in areas. As I say, if you can read the text at the bottom, the pressures that you are getting as a sector from all kinds of groups to limit palm plantings is having an effect on what is happening in Malaysia and Indonesia. If you look, the blue line for Malaysia is below the long-run trend. The red line for Indonesia is also below the long-run trend. The impact of this particular pressure from the EU is to slow the rate of growth in palm areas below what it was on trend before. It is increasing, well, increasing sounds the wrong word, but it's magnifying the extent of the slowdown in palm areas. You know, especially for public companies, I don't show it here, but if you look at publicly quoted companies, there's very little new planting. Replanting, yes, but not new planting. So there's been an enforced slowdown in the palm area growth. And I call it the law of unintended consequences, because if you think logically, if we're not going to be getting as many as much new supply of palm oil because the area is now growing very slowly indeed. If you're not getting the palm oil, it has to come from somewhere else. And for a whole variety of reasons, the logical alternative source of oil is going to be soybean. You can't really expand rapeseed, canola, or sunflower oil by very much. So it's going to be soybean. But if you're trying to really boost further, there'll always be growth in soybean for meal. But if you try to plant even more soybean to get the oil to replace the lost palm oil, you're going to be pushing down the meal price because you're suddenly adding even more meal to the world's supply, more meal than the world was wanting. So the meal price goes down. But you want people to plant more soybeans. And because soybean is roughly 80-20 meal to oil, if you think logically, just to keep the soybean price stable, for every dollar fall that you force on the meal price by increasing supply too much, you need at least a $4 rise in the oil price. But we're trying to encourage people in Brazil to plant even more soybeans. And I believe that this is going to have a significant impact upon the world price of soybean oil in the long run. And because soybean and palm oil compete, one of the unintended consequences of the policy to slow palm plantings is going to be, in a few years' time, to be forcing up vegetable oil prices, including CPO. That's why I call it the unintended consequence. One unintended impact of EU biodiesel policy of pressure to slow plantings is going to be actually to increase the long-run price of palm oil, making palm oil more, not less attractive as a crop. If we now turn to I've touched very quickly, I've mentioned EU biodiesel because we know that they're trying to phase out palm oil. I've mentioned US, but let's look at this region. And if you look, we have Indonesia is rather vague about exactly how the mandate's defined. But here you can see that right now, the official mandates, Colombia, 10%. These are the world's 4 biggest palm producers. Colombia, Thailand, 10%. Malaysia, only 7%. And we have Indonesia with actually a variable mandate. It's not fixed. And those who've heard me talk before, I admire what the Indonesians have because it's a flexible system. I think you know Indonesia has a pot of cash from the export levies, which it can use mainly to subsidize. It's used mainly to subsidize biodiesel because they want to do replanting, but it's taken a long time to increase the rate of replanting. And what I just illustrate here, which is why I admire it in terms of flexibility, I'm just illustrating an example. In this diagram on the right, I am showing you, if you assume, which is realistic, that the CPO fund has, let's say 700, it sounds a lot of money, but they may actually have more, but let's say $750 million a year to subsidize biodiesel. And I'm taking a slightly lower crude oil price than today. I'm taking a price of $65 a barrel. And there's a formula for paying for PME in Indonesia, the way the subsidy works. I am showing you the trade-off about the size of the mandate in Indonesia. If you look at this diagram, if the FOB price of CPO with $65 Brent, with $750 million to spend on biodiesel subsidy, if the FOB price on the left-hand side is $625 a ton, then the Indonesian system could subsidize nearly 6 million tons of biodiesel from $750 million. But as the CPO price goes up, let's say the price is something like $750, quite a lot higher than today, then the amount that could be subsidized goes from nearly 6 million to 3 million, because the same amount cannot cover as much subsidy. And I think that for many reasons, that's a rather intelligent policy. When prices are low, the palm producers for the world, not just Indonesia, would like the price to rise. So if the gap between palm oil and crude oil is very small, you can subsidize a large volume, which will reduce stocks and push up prices. As the gap gets wider and wider, when palm oil gets further and further above petroleum, the fund cannot subsidize so much. But as prices get higher, you don't want to push them up by so much. You know, you have food demand, you have cooking oil demand, you have other pressures. So you're trying to get a balance. And the Indonesian system, the theory of it doesn't quite work like this, because they set allocations for several months at a time. But the Indonesian system in the background is a system which adapts in an intelligent way to the gap between palm oil and crude oil prices. So when we come to the outlook for CPO today, we've got all these things going on in the background, and biofuel is really important, and policy matters. What I want to start by looking at is the actual fact about what's been happening to growth rates in CPO output. And I actually, in these two diagrams, I'm going to look at the same 4 big palm oil producers, the really big ones, Malaysia, Indonesia, and then on the right-hand side, I'm adding Colombia and Thailand. And what's fascinating is if you look at the left-hand diagram, what I'm showing you in both diagrams is year-on-year change in quarterly output of CPO. So it's Q1 2018 on Q1 2017, Q2 on Q2, year-on-year change. And if you look at the left-hand diagram, right up until more or less the middle of last year, Malaysia and Indonesia went together. And then something happened. And I cannot really tell you what happened because I don't fully understand it. But if you look, it's incredible. The blue line, which is Malaysia, which was having strong growth year on year, fourth quarter last year, first quarter this year, the blue line is quite positive. Suddenly it went negative in the second quarter. Indonesia did exactly the opposite. Indonesia went negative the final quarter last year, negative growth year on year, first quarter this year, and now it's bounced back to strong positive growth. Malaysia and Indonesia are out of phase with one another. This is very unusual. I can't think of another time it's been like that. I would love to know what the explanation is. And actually Indonesia matters because it's a much bigger producer, about nearly twice as much as Malaysia right now. So I thought, let's look at which one is unusual. Is it Malaysia or is it Indonesia? That is why I did the same diagram, but it's Malaysia against Thailand and Colombia. And you can see that the rest of the world, besides Indonesia, is in step. Everybody seemed to have strong final quarter last year, still growth first quarter this year. And then by the second quarter of this year, besides Malaysia, Thailand and Colombia have gone negative. So we have these two quite different patterns of growth. Indonesia on one side and the rest of the world on the other side. And that's the situation we're starting from when we're making forecasts for this year. So on the left, I am showing you our current forecasts of what's happening to year-on-year production growth. Red is Indonesia, blue is Malaysia. So we're seeing Malaysia finally coming up by the end of this year back to positive growth. Indonesia is slowing down, but it remains positive. So Indonesia is the one that is going to be key to the growth in world CPO output this year. And because it's a much bigger producer, it's actually going to be overall, if you look at the right-hand side, I'm showing you quarterly. Now it's in production. Now it's in million tons of CPO. The one on the right is adding together Malaysia and Indonesia to show year-on-year growth. If you look, final quarter of last year, first quarter of this year, almost no real change in palm oil output. Malaysia and Indonesia balanced. And then we start to see Indonesia leading the way. Good growth over 1 million tons Q2, growth of just under 1 million tons Q3, and growth of 2 million tons in Q4 year on year. So for the world as a whole, there'll be an increase of about 4 million tons. But that is all going to be from Indonesia, because currently we expect Malaysian output to be down by 2, even up towards 300,000 tons this year. This contrasting pattern, as I say, I would love to know why it is there. It can't just be labor, because that's why I showed you Colombia and Thailand. It seems to be something which is special, and it happens because Indonesia is such a big producer. That's very important in setting the trend for world output. So this year we're going to be having big production increase led by one country. Now let's look where we are today, and this is, I think for most of you now, a very familiar diagram, the price band. These are EU prices. The price at the bottom, the yellow, is Brent, North Sea crude oil, dollars per ton. Red is palm oil, and then you can see the other oils above that. We are back more or less where we were in 2008, in 2012, 2013, 2014. We are back at the bottom of the price band where palm oil and crude oil in Europe have come together. It's slightly above, but very slightly above, actually. Palm oil is very slightly above crude oil in Europe. But the price band is alive and kicking, and we are, because stocks are relatively high, they're going to rise. We are now at the floor to the price band. And the big question then is, how will prices move going forward? An interesting diagram in terms of the short-term outlook is the one on the left. Europe isn't where the market for palm oil is made. It's just nice to take Europe because there you can get everyday prices for palm oil, for soybean oil, for rapeseed oil, for sunflower oil, for all the oils. That's why I use Europe for comparing. But actually what matters is what's going on in Malaysia and Indonesia. So this one on the left is again the premium over Brent in dollars per ton. The blue is inside Indonesia, taking account of the export levy, $50 a ton. The red is the local delivered price in Malaysia, published every day by MPOB. And you can see back 2012, 13, 14, and nearly happened in 15, you can see there were big discounts of palm oil in Southeast Asia on crude oil. This year in Indonesia, we again have a big discount of CPO on crude oil. And so the crucial question is, how quickly will demand respond to these price incentives? And it's not going to be food demand, it's going to be biofuel demand. And if you look, to me, the interesting one, which is my diagram here on the right, what you can do is you can see exports of biodiesel from Malaysia and from Indonesia. And I'm just showing the two main export markets. I'm showing you EU and China. The blue is Indonesia to EU. The green is Malaysia to EU. The red is Indonesia to China. And then the little brown one on top is Malaysia to China. And then the solid line that you can almost see here is the premium in Europe of CPO over Brent. These are monthly prices, and I include an estimate on the basis of August so far of exports of PME in August. What I want you to see is there is quite a big chunk now, which is well over 100,000 tons each month in the last few months, of price sensitive. It's not subsidized, it's free market, because PME is now competitive with gas oil in Southeast Asia. You are seeing the market respond. It's responding actually much quicker than it did in 2012, 13, 14. We are not needing big discounts of palm oil on Brent. At more modest discounts, there is a margin to be made, especially in Indonesia, and this is being converted into price-sensitive exports of biodiesel, which is really important because, of course, this helps to reduce stocks. And this is on top of the mandate inside Indonesia, which is also being increased with the non-PSO element, because it's not just policy, it's because it is attractive at these prices to be selling biodiesel to non-PSO as well as PSO fuel market. So, what does this mean in conclusion, and what are the price implications? So first of all, I wanted to illustrate the diversity of policy responses. I've explained to you the policies that the Trump administration has followed with the tariff war with China, with the EPA turning against biofuels. You have seen how this has had a significant depressing effect, and for palm what matters is soybean oil. Soybean oil prices are at their lowest point for nearly 2 years because of policy, not because crude oil's gone up. It's because policy has turned against soybean and soybean oil and biofuel. As I pointed out, the paradox about EU policy is if it's followed logically by slowing the growth in palm areas, it's going to put more pressure on soybean oil supplies to meet the world demand for oils. And this in the long term, because soybean is mainly meal and less than 20% oil, the net effect is going to be to pull up the oil price, which will benefit CPO. I then make my point about mandates. Malaysia actually has the lowest mandate of the 4 main palm oil producers. It also has a lower mandate than Brazil or Argentina among the soybean producers. And then on the other side, we have the one which I find a fascinating system, which is the Indonesian one, which has a flexible mandate, which is responsive to the price signals for subsidizing more or subsidizing less biodiesel, because the industry itself has created this pot of cash which can be used to subsidize. And you can subsidize more when the spread is very low. And I cannot stress how much I see the importance of Indonesia in defending the floor to the price band. Because it's created a flexible demand, which could easily be up to, including there's some discretionary, almost not recorded biodiesel demand in Indonesia. Free market, biodiesel is cheaper than diesel in the free market today. You can get it more cheaply. Maybe as much as 5 million tons could be used in biodiesel this year in Indonesia, quite apart from what goes to China. So what about prices? As I say, one factor which makes it slightly unlike the last few months is, of course, we're now in a period where there's a zero export tax again on Malaysian CPO. I don't have time to talk about how this is going to alter the balance between Malaysia and Indonesia in refined exports. Indonesia should now be stronger in refined, and Malaysia will have to export more as CPO. But if you take Brent, let's assume it stays more or less today, $75, then BMD, because we're getting the upward pressure still from rising production on stocks, we're going to be seeing BMD around 2,200 till December. But Indonesia is going to be crucial in keeping the peak stock maybe to under 2.8 million tons. And by January, with stocks coming back down, CPO will go up to 2,400 here, and it'll be $640 per ton in Rotterdam. So I've just run out of time, and I've got to catch a plane to Jakarta. So thank you very much.